Hi guys, Mark here from the Patterntrader. It's Sunday, August 23rd. We're a couple of hours before the trading for the next week. What I'm going to do is going to review some of the open positions we have that are carrying from last week, and also looking at some important market formations that will be governing, I think, price behavior in the coming week as well as the next several weeks or months going forward. So let's dig right into it. Right here we have before us is the Australian versus the New Zealand dollar. This market has been going up for the last 3, 4, 5 months, from the roughly parity level to almost the 114 level. But recently we started seeing some chinks in the armor in this bull market, and we started to note that there was a potential for a turnaround. So the first thing we're looking at here is this potential double top that we noted last week. So we're looking at a double top in the Australian versus the New Zealand that came in right about the new highs at the 114 area. We actually had a smaller double top right here. And then last week we basically said that we were going to get short at the 111.09 area, just below this inside day bar. So again, as you will recall, we have a couple of steps to our trading methodology. The first is we denote a trading pattern. Here it's the double top. Here we had an inside trading bar here. And then the third is we put our sell stop just outside the low of this inside day bar at 111.09 on a sell stop. The market did break through that and is now sliced through that very nicely. We're now looking at almost 200 pip profit in the Australian versus New Zealand dollar. I'm still looking to hold this position. My initial target objective, as you recall last week, was about this 108.5 gap. I think this market looks like it's shooting for at least that level, if not much lower. This market is starting to look very heavy with a big rounding top. We did penetrate one of the necklines here already. The big test of support is coming right at the 109 area, and then I think penetration below that we could have a substantial fallout. So we're still carrying our core position short Australian New Zealand dollar for the time being. The next open position we're looking at is the euro versus the British pound. We bought the euro versus the British pound last week, primarily again on our analysis that there was the presence of this double bottom. We also have a second pattern here, which is the inverted head and shoulders with the left shoulder here, the head coming in here, and it looks like the formation of the right shoulder there. So we have a double confirmation. We also had the inside day bar right here, where we put our buy stop just above the high of this inside day bar at 70.97. We were immediately triggered into this coiled position, and you can see that the market just sprung right out of the coil. Currently trading at 72.47. We're looking for a first price target of at least the 73.5, and then possibly 75 in fairly short order for this position. So we still have our position intact on the long euro versus the British pound. We do move our stops up to protect our profits, but based on what this formation looks like, I think we're just in the early stages of this market turning from a bear market to a bull market, underpinned by this double bottom inverted head and shoulders pattern that should drive prices much higher. And we're going to take a look at the dollar complex in more detail right now. So in the last couple of weeks, you can see in the dollar complex we have here, it's been a very sideways affair, and it could have gone either way as to the breakout of this sideways pattern. But as always, based on our primary belief that there's always an underlying pattern that once we detect that, will ultimately drive the market direction. And for us, there really has been no secret. For the last 6 months or so, we've been saying that this pattern here, this double top right here in the dollar complex at or around the 112 area, has been going to be the ultimately the prevailing and driving force in the dollar complex. You can see a little double bottom here, but I think it's this big overwhelming pattern right here that we're seeing in the US dollar complex that is going to be driving prices forward. And now we've had a breakdown of this initial sideways level. We broke down last week, and now we've decisively penetrated this sideways pattern to the downside. Again, every indication was back in the March-April timeframe as to the ultimate direction that this dollar would ultimately break down from. The flip side of the dollar coin is the euro versus the US dollar right here. This is the last 6 month chart. We're looking at the euro versus the US dollar. For the last several months, it's been pretty much of a sideways affair with the unknown as to which way this dollar was going to break. As a backdrop to the euro US dollar, we've had the Greek debt price crisis. We also had the ECB doing quantitative easing, lowering rates in the euro. Both of these effects, the euro debt crisis as well as the ECB quantitative easing, on the surface should have been negative to the euro versus the US dollar. But again, we've been focusing on this pattern back here in the March-April timeframe, where after coming from the 138 area, the market bounced at 105 in March, bounced back to the 110 area, came back to 105, and now has created this very prominent double bottom. And I've been saying for the last 6 months that this is going to be really the driving pattern for the euro versus the US dollar. So even though on the surface fundamentally we've had a lot of bearish information driving the euro, it has not been able to penetrate on the downside. And last week we did penetrate now substantially on the upside. In fact, a week or so ago, we did a report showing basically these two key reversals in the same area. We did start buying the euro right here, and we were unperturbed by the adverse fundamental news driving the euro. So as you can see, just using clean price chart analysis, no indicators, you can start to see how the market points to the direction that it ultimately wants to take. You know, focusing on news, especially the negative news driving the euro. On the surface, it looked like it was very bearish for the euro, but we think the euro is ultimately headed at least to the 120 area based on the underlying double bottom that was baked in the cake back in the March-April timeframe. The last market we're going to focus on in this weekly recap is the Nasdaq 100. The U.S. markets took a big tumble on Friday, with the Dow Jones being down about 530 points, about 3.5%. We did a report a month ago starting to see the emergence of this reverse wedge in the Nasdaq, which started to look something like this. Let me just draw this another way. So on July 26th, we did a special video report in which we started to note the emergence of this reverse triangle in the Nasdaq 100. This is called a reverse wedge triangle, or it's also known as the megaphone top for the kind of formation that you see in front of us. And I noted, even though it was premature, we were making this call right around this time frame here. But you know, I said that if we did fall to the 4,300 level, that this formation will be complete. And that completion of this, we're now looking at a measured move from top to bottom of about 400 points. So from the 4,700 to the 4,300 is about 400 points. So that confirmation of this triangle, which now looks like it's finally been confirmed, we actually fell well below it on Friday, would now take us at least 400 points lower than this neckline to at least the 3,900 area. So I think we do have much lower to go in the U.S. stock market indexes. The reverse wedge is not really a very reliable formation, and it when it breaks, it can now then break upward. So we're going to be on the alert for that. But I do think that based on what we're seeing, that a 3,900 target on the Nasdaq is well within reach. So that's it for this week's report. We wish you a healthy and prosperous trading day.